Hello, and welcome to our review of Callon Petroleum Company as a part of Tulane University's Burkenroad Reports. My name is Adam Griego, and Matt Haggerty and I will be representing our teammates Alexandra Clark, Jordan Cooper, and Shale Cooper. In this presentation, we will give an overview of Callon's business model and its corporate strategy. Next, we will discuss our valuation and target price for Callon and the recommendation that we give along with it. In the investment thesis, we will discuss how Callon can grow in the future. We will then review the risk that the company faces and Callon's peers in the industry. Lastly, we will discuss our meeting with CEO Fred Callon and other company executives. Callon is headquartered in Natchez, Mississippi, and it operates in the oil and gas industry where it specializes in the exploration and production of oil and gas properties. The company primarily invests in oil and gas projects in the Permian Basin located in West Texas. As of October 2013, Callon has reserves of 14.1 million barrels of oil equivalent and a market cap of $210 million. Callon is trading at 150.3 times its earnings and has an earnings per share of 5 cents. In addition to its headquarters in Mississippi, Callon has its technical office in Houston, Texas, and its field operations office in Midland, Texas. Currently, Callon has properties in the Permian Basin, Haynesville Shale, Gulf of Mexico Shelf, and Gulf of Mexico Deepwater. However, the company plans to sell the majority of its Gulf of Mexico Shelf and Deepwater properties by November 30th, 2013. The company owns 32,600 net acres of land in the Permian Basin, where the majority of its focus is for development. Starting in 2009, Callon executives and board members began increasing their onshore production base by purchasing and processing lower-risk oil and natural gas fields. These reinvestments allowed Callon to increase its chances of finding oil and natural gas in existing and new fields while lowering its reinvestment risk. By strengthening their onshore production base with these reinvestments and the sale of their Gulf of Mexico assets, Callon intends to increase stockholder value by increasing its drilling properties. In addition to the increase of its onshore production base, Callon's two other strategies to increase shareholder value are to have efficient capital appropriations and to deliver on asset growth potential. Now, Matt will discuss our valuation and one-year target price for Callon.
The table to the right shows the historical Burkenroad ratings and prices since 1999. We forecast a one-year increase of 100% from the October 30th, 2013 price of $6.96 to $14. We give Callon Petroleum a market outperform rating throughout the next year. We gave Callon a one-year target price of $14 based on PV10 and enterprise value to production valuation methods. We used a 3- and 5-year PV10 discounted cash flows model, which is based on forecasting production and commodity prices. We then discounted those cash flows at 10% to find the net present value of the cash flows and used our estimated number of shares outstanding to arrive at a target price. Then, we used an enterprise value to production model. We calculated an average enterprise value to production multiple for Callon's peer group and then adjusted for Callon's 12-month target production. Moving forward, Callon will use the proceeds from the sale of its Gulf of Mexico assets to further develop its Permian properties. Callon hopes to have large onshore production gains from new horizontal drilling techniques, which will allow it to produce out of larger areas. With a debt-to-equity ratio of 0.84 compared to a peer average of 1.75, Callon is capable of issuing new debt in the future to accelerate expansion. Callon faces many risks that may hurt its shareholder value. Callon has rapidly increased capital expenditures in the Permian Basin. It must see a large increase in production in order to support these expenses and its dependence on debt. Also, in order to protect itself from commodity price volatility, Callon must properly hedge its production. After the implementation of the Dodd-Frank Act, reporting requirements for hedging activities were increased. Hydraulic fracturing poses another risk to the company because it has created environmental concerns which have prompted new regulations in the oil and gas industry. As of October 30th, 2013, Callon produced from both onshore and offshore properties. Despite its plans to soon move onshore, we consider it a diversified E&P company. In Callon's peer group, we considered both onshore and diversified companies. Callon's onshore peers consists of Diamondback Energy, Pioneer Natural Resources, Concho Resources, and Laredo Petroleum. Its diversified peers are PetroQuest Energy, Stone Energy, and EPL Oil and Gas. This table analyzes the similarities and differences of Callon and its peers. In many instances, the company differs greatly from its peer group. Callon has a significantly lower debt-to-equity ratio compared to the peer average. Also, Callon's price-to-book value of 0.77 is significantly lower than the peer average of 2.71. Callon also differs greatly on its total proved reserves, but that is likely caused by the huge difference in company size among its peers. We were given the opportunity to meet with CEO Fred Callon and other Callon executives. We gained insight on their strategic initiatives and plans for the future of the company. We were also able to ask questions to solidify our assumptions and understandings of company operations. The Burkenroad reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.